Hello, everyone. Welcome to the market opening bell on Thursday, April 17th. The US restricted exports of NVIDIA's H20 chips to China, and the White House indicated that Chinese goods face tariffs up to 245%, putting pressure on Hong Kong stocks. The Hang Seng Index opened 149 points lower and extended losses, dropping as much as 597 points to a low of 20,868. It closed down 409 points or 1.9% at 21,056. The Hang Seng China Enterprises Index fell 203 points or 2.6% to 7,779, and the Hang Seng Tech Index declined 185 points or 3.7% to 4,796. Total market turnover reached 219.9 billion Hong Kong dollars. Southbound funds recorded a net inflow of 7.894 billion Hong Kong dollars into Hong Kong stocks, with net purchases of tracker fund 1.705 billion Hong Kong dollars, Alibaba $1.323 billion, China Mobile $477 million, Tencent Holdings $395 million, PopMart $308 million, and Meituan $241 million. Net sales included Xiaomi and SMIC. Uh, the net sales were 946 million and 222 million dollars respectively. Data shows southbound funds net bought Meituan or for 9 consecutive days, totaling 5.44752 billion Hong Kong dollars, while net selling SMIC for 4 consecutive days, 1.4189 billion dollars, and Xiaomi for 2 consecutive days, $1.47436 billion. Technical analysis: the Hang Seng Index fell below its 10-day and 100-day moving averages, finding support near 20,900 but closing above 21,000. The 10-day moving average crossing below the 100-day moving average formed a death cross, signaling bearish momentum. If 20,900 is breached, the next support level is 20,450. Mainland Chinese markets showed mixed performance, with the Shanghai Composite Index turning positive late in the session, while the Chinex Index fell over 1%. The Shanghai Composite Index dipped to a low of 3,233 and closed at 3,276, up 9 points or 0.3%. The Shenzhen Component Index fell to a low of 9,650 and closed at 9,774, down 84 points or 0.9%. The Chinex Index closed at 1,907, down 23 points or 1.2%. Combined turnover in Shanghai and Shenzhen reached 1.1119 trillion yuan, up 34.8 billion yuan from the previous day. The renminbi central parity rate against the US dollar weakened by 37 pips to 7.2133. According to the National Bureau of Statistics, China's first quarter GDP grew 5.4% year-on-year, beating expectations and matching the 5.4% growth in Q4 2024. Quarter-on-quarter, GDP rose 1.2%. The urban unemployment rate averaged 5.3% in Q1, with March at 5.2%, down 0.2 percentage points from February. Key economic indicators outperformed expectations and accelerated from the first 2 months. March retail sales rose 5.9% year-on-year, surpassing the 4% growth in January-February and the expected 4.2%. Fixed asset investment for Q1 grew 4.2%, slightly above the 4.1% in January-February and expectations. Industrial value-added output in March surged 7.7%, well above the 5.9% in January-February and the expected 5.8%. In real estate, Q1 investment fell 9.9% year-on-year, slightly worse than the 9.8% drop in January-February. New commercial housing sales area and sales value declined 3% and 2.1% year-on-year respectively, improving from 5.1% and 2.6% drops in January-February. Market highlights: investor focused on JD.com and Meituan encroaching on each other's core business areas, raising concerns about intensifying industry competition. Meituan fell 8.1% to 134.9 Hong Kong dollars, and JD.com dropped 5.5% to 138.4 Hong Kong dollars. This year, tensions between Meituan and JD.com have escalated. JD.com launched its food delivery service, JD Delivery, in February, targeting premium delivery and entering the catering delivery market. JD Delivery offers zero commission to attract merchants, provides full-time riders with social insurance, and introduced a 10 billion yuan subsidy this month for all users. Within 2 months, JD Delivery's daily orders exceeded 5 million compared to Meituan's tens of millions daily. Meituan countered by launching its instant retail brand, Meituan Flash Purchase, on Tuesday. Positioned as a next-generation shopping platform accompanying consumers 24/7, it partners with retailers, brands, and local merchants across nearly 3,000 counties, cities, and districts to serve the daily shopping needs of 1 billion consumers nationwide. In the U.S. stock market, Nvidia faced a U.S. restriction on chip exports to China, leading to an early decline in U.S. stocks. Nvidia shares dropped as much as 10.5%, closing down 6.9% at 104.49 US dollars, making it the worst performing Dow component. Other chip stocks were also hit. AMD fell 7.35%, while Micron Technology and Broadcom each dropped 2.4%. Federal Reserve Chairman Jerome Powell spoke on President Trump's new policies, highlighting significant uncertainty about their economic impact. He noted that tariff hikes far exceeding expectations could intensify inflation and slow economic growth. This led to expanded losses across major indexes. Dow Jones Industrial Average fell as much as 974 points, or 2.4%, closing at 39,669, down 699 points, or 1.7%. Nasdaq Composite dropped up to 756 points, or 4.5%, closing at 16,307, down 516 points, or 3.1%. S&P 500 declined up to 175 points, or 3.25%, closing at 5,275, down 120 points, or 2.2%. The Nasdaq Golden Dragon China Index, reflecting Chinese stocks, closed down 2.7%, with Alibaba falling 4.93%. Magnificent Seven all slumped. Tesla, down 4.9%, was impacted by reports of U.S. tariffs disrupting its production plants. Apple, down 3.9%. Microsoft, down 3.7%. Amazon, down 2.9%. Meta, 3.7%. And Alphabet, down 1.9%. On economic data, March U.S. retail sales rose 1.4% month over month, slightly above the expected 1.3% compared to 0.2% in February. This was the largest increase since January 2023, driven by a 5.3% surge in auto and parts sales as consumers rushed to buy before upcoming auto tariffs. March U.S. industrial production fell 0.3%, exceeding the expected 0.2% decline. Oil market news: the U.S. Energy Information Administration (EIA) reported that U.S. oil production will peak at 14 million barrels per day in 2027, maintaining this level until 2030 before rapidly declining. By 2050, production is expected to fall to 11.3 million barrels per day from this year's 13.7 million. U.S. oil demand recovery post-COVID is projected to end next year. In 2019, pre-COVID, U.S. oil consumption averaged 20.54 million barrels per day, with a historical peak of 20.8 million in 2005. Our stock pick today is Shanghai Henlius Biotech, stock code 2696. Shanghai Henlius Biotech is primarily engaged in the biopharmaceutical business in China, focusing on the development of biosimilars and novel drugs for the treatment of tumors and autoimmune diseases. Leveraging its comprehensive antibody drug technology platform, the group empowers the development of innovative therapies while deeply investing in next-generation innovative antibodies and antibody-like drugs. In the development of T-cell engagers, the group has created highly specific drug products targeting solid tumors, effectively overcoming the immune microenvironment of solid tumors to activate the body's immune response against tumor cells. In the field of antibody drug conjugates, ADCs, the group's 100-gator R&D platform excels in developing ADC products with high safety, selectivity, and efficacy, expanding the application scenarios. Currently, the group has successfully launched 6 products covering 24 indications in China and 4 products in markets including Europe, the United States, Canada, Australia, Indonesia, and Bolivia. Last year, the group completed the acquisition of Shanghai Fosun Henlius Pharmaceutical Trading Company Limited, formerly Shanghai Baodao Hongshun Pharmaceutical Trading Company Limited, which holds a pharmaceutical business license. This acquisition enhances the group's ability to commercialize licensed products, expands its distribution channels, and broadens its business model. For the year ended December 31st, 2024, the group recorded total revenue of 5.724 billion yuan, a 6.1% increase from 2023, driven by drug sales, R&D services provided to clients, and licensing income. Total profit reached 820 million yuan, a significant 50.3% increase, primarily due to the continued sales growth of core products following their commercialization. The group has a commercial production capacity of 48,000 liters, including 24,000 liters at the Xuhui base and 24,000 liters at the Songjiang base. In terms of R&D, the group's pipeline includes approximately 50 molecules and 14 R&D platforms, covering a diverse range of drug formats such as monoclonal antibodies, bispecific antibodies, ADCs, fusion proteins, and small molecule drugs. The group boasts a mature global regulatory and clinical operations team, advancing its pipeline products worldwide. Multiple international multi-center clinical studies are currently underway in countries including China, the United States, Japan, Australia, Spain, Germany, Poland, Hungary, Latvia, and Indonesia. Recommendation: buy at 31 Hong Kong dollars, target 34 Hong Kong dollars, stop loss at $29.5. I do not hold the above stock.